I find language very funny, and note-taking I appreciate. I thought you would think this is good too. And it's from your favorite publication, the Wall Street Journal. So when did this drop? This was on March 26th. So Mike O'Brien, he's a Ford executive. So Mike kept score of his colleagues' verbal flubs.
I saw that. I didn't read the article, but I saw it.
So Michael Bryant kept a meticulous log of mixed metaphors and malapropes uttered in meetings over a decade. So quite literally, as little as during a 2019 sales meeting to discuss a new vehicle launch, a colleague blurted out, "Let's not reinvent the ocean." So he kept the receipt on that. At another meeting in 2016, someone started a sentence with, "I don't want to sound like a broken drum here." So this guy's keeping receipts on all these little things. He's got a leaderboard and everything. Shout out Mike O'Brien for keeping it light. Thanks, Mike. Welcome. I am Marcos Segrera here with my best bud, Brett Horowitz. Brett, how are you?
Good. What's first off on these charts?
Here's simple. I'm not going to talk about tariffs, number one, but what I am going to talk about is the growth of dividends. So, Brett Horowitz, how many friends and clients have asked you, what should I invest in to be able to avoid the inflation trap? I hear all these assets gain value over time, and I think one thing that is, again, unfortunately kind of shirked to the side, I think perhaps because it's too simple, is dividends. So when we talk about total return in portfolios, we're talking about growth of assets, but also in dividends. And this nice little chart from Axios and our friend Felix Salmon. So this chart right here that we're looking at is showing the change in S&P 500 dividends, the median earnings, and consumer prices. So basically the green line is your CPI, it's inflation. The purple line is growth of dividends, right? So basically, what all folks can do is there are worse things for you to do than just investing in your good old-fashioned S&P 500 if you want to try to get away from the inflation bug. The last bout of inflation, which was January 21 to July 2022, consumer prices rose 12.3%. And what the comparison is being made here is median earnings, right, a source of income. Generally, you can't necessarily trust it to keep up with inflation. Over that specific period of time, when CPI was up over 12%, median earnings were up 8.9%, but S&P 500 dividends were up 13.3% in that same 18-month period. So while that's kind of a very myopic look at it, this chart, I think, does a great job of showing you dividends not just keep up with, but meaningfully outpace inflation over time. And I think that's just, again, the innovation of these companies getting rewarded over time. This doesn't even take into account price appreciation. So I'm not sure if you have any thoughts on this, but I thought this chart did a good job of illustrating the point.
So this is saying the change in dividends as a dollar amount that the S&P 500 companies spit out increased by that percentage, 648% over that period of time.
Since 1990, yes, sir. And over that same period of time, CPI is up 160%.
Well, I guess that also includes Walgreens, which dropped its dividend and cut its dividend completely that you picked last year as your stock of the year.
I was wondering when you were going to stick that in there. Yep. Yeah, Walgreens. How's CVS doing?
No clue.
Yeah, I have no idea either, but I didn't pick it. Tell you that much. I'm pretty sure it doubled in value through mid-January. So yes, this is showing the compound effect of dividend increases. Be along for the ride. I think it's a good choice.
Okay. So those are your stable companies, what? Your banks, your industrials, your consumer staples, right? Things that have been around forever and have some solid cash flow.
Yeah, generally speaking, but I also, and again, that's another thing, right? A lot of folks will come and say, I want the dividend payers. I don't think you necessarily need to focus on just the dividend payers, so to speak. A lot of companies pay dividends, right? Which is redistribution of capital back to your shareholders without being called a specific name, right?
Yeah, I mean, even some tech stocks now, right? They have so much cash flow, making so much money, they're paying out dividends now.
Damn right they are, 100%. All right, so Vol, look, so we're kind of joking about tariffs here, which is, again, Liberations Day is tomorrow. So this video will drop after we see what happens with reciprocal tariffs from the Trump administration. But volatility has been in headlines through April 1st today, right? So all of 2025. But I think it's interesting to point out that even though we're getting what feels like a chaotic administration in its first 66 days, right? It's a lot that's happened in 66 days. And I think that's because they know that midterms will be their first kind of inflection point. If we look at actual +2 or -2% moves in the day, we actually have had zero in 2025. So at no times in any single day of trading has the market been up 2% or down 2%. And when you look historically, what this chart is kind of telling us is in 2023, or excuse me, 24, we had 6 of those. In 23, we had 2 of those. And we'll should note when we get big pops of those, so days when you're experiencing, years when you're experiencing a lot of that, you're actually usually getting down years. And it's interesting to look at when you have 10 or more days over the course of that 365-day year, you're actually looking at usually bad performance, right? So
Right.
fall, not necessarily great, but climbing that wall of worry with limited volatility ends up with better returns on average in any given year. So I thought this chart did a good job of illustrating the lack of vol and what happens when we do get those big moves.
It's very surprising. I would have thought we've had some big days. I probably the Dow has seen more big days than others, or the Nasdaq has seen more big days than the S&P. The nice thing is people look at a big day where S&P is down 100 points and go, "Oh my God, that's less than 2% now." So thankfully, because the S&P has gone up so much from 666 back in 2009 to where it is today, over 5,500, I guess now. 100 points is not even 2%, and so the dollars means less as a percentage of where it was versus where it was in the past. I am surprised by this. I would have thought there were more big days that were down. I wonder if people are just sort of not moving the market more because there's not really much news to move on, right? Every day there's chatter about what could happen and this could happen, but there's no, until we know tomorrow what's going to happen with tariffs. That seems to be the most thing on people's minds. And maybe they're just waiting for that day to actually happen before something big up or down happens.
Yeah, like I think it's a bad use of time for the folks on our side of the line, whatever you want to call it, of just, hey, my job is X and I'm just trying to build wealth owning a portfolio of companies. Worrying about tariffs is a bad job. I think you're outsourcing that worry to the companies that you own. Those are the ones who don't like the uncertainty of what the Trump administration is doing right now, but they're going to be good stewards of your wealth, assuming capitalism keeps doing what it does.
But yeah, I mean, for us, worrying about tariffs is a fuel exercise. For those that are making widgets in a country affected, they're worrying about it for months and months and months, and probably putting in Plan B and C and D into here, given what could
Exactly.
happen.
Yeah, car companies should care a lot more than a partner at a law firm.
Okay, so let's start with median home buyers. We were both, I think, a little surprised by this. It came out in the news in a chart recently, and because of the rising home prices, because of high mortgage rates, right? We know that anyone who locked into a home 10 years ago, 5 years ago, got a very low mortgage. For those that are either a first-time homeowner or trying to move, those high rates and the high prices have pushed the median age of home buyers to a record high 56 years old in 2024. That's up from 45 years old in 2021 and only 31 years old in 1981. I don't know if this is a trend that will continue. I know talking to a lot of the colleagues in our office who are on the younger side, they're not seem to be interested at all in ever owning. There's a bunch that are and are looking in the next few years to probably get something because it doesn't look like rates are going to go down anytime soon. And so you just have to probably, bite the bullet, if that's the right saying, and do it one time or another. But for a lot of people, they just don't see the value of homeownership. They see the cost of the down payment, which is hard to get, especially in certain areas, the cities where people want to live, the young people want to live. And then they see all the upkeep they've got to do. And so this could be less and less homes that people buy, and maybe then you'll have more supply, which will be good.
I'm not smart enough to know what the next 50-year holds for real estate and home ownership, but I think it's interesting how a lot of what I would generally label as thoughtful people have come out and said that home ownership was bastardized a bit and oversold as a benefit, and you ended up with a consumer that was so dependent on the housing market just increasing in value every single year in order to feel wealthy, and because they've absolutely just concentrated their entire balance sheet in a piece of property. So perhaps this helps diversify the average American's balance sheet because you're eventually to become okay and you won't feel like a pariah because you don't own a house. I think a lot of folks get a bad rap for being renters and not homeowners. But again, who knows what the heck's going to happen over the next 50 years. You need more supply to come online. You'd ideally love for less government subsidization of this stuff because that always just ends up making prices go higher, perhaps unnecessarily. I have no idea.
But look, the government did push people to buy homes years and years ago through the real estate tax deduction, mortgage interest deduction. All those things have lost a little bit of their luster as the standard deduction's gone higher. Less people are itemizing, right? So that probably factored into as well a little bit. You say, well, if I'm going to get the same deduction, I'm not getting the benefit of owning as much as I did in the past.
Yeah. Yeah, I hear you. 30-year mortgage at 6.6% last I looked, off a high of 7.7. So lower, but still not screaming buy.
Yeah, I mean, I don't see, I don't know about you, but I don't see fours, fives anytime soon.
I don't know. The 10 years at 4.1, and the spread between, it's just 2.4% or so is kind of the spread, and it's kind of stayed tight. So unless that comes down, right? I don't know.
Talked about AI.
AI. So this is just kind of this commentary, and I know like you can't avoid this conversation or hearing about it. And I just thought it was interesting to have this chart from Visual Capitalist, which is the growth of the AI hyperscaler. The hyperscaler, just to define it, because I think it's getting thrown around a fair amount. And here's perplexity with the definition of the hyperscaler: a company or organization that operates large-scale data centers designed to provide massive computing power, storage capacity, and networking resources. So AWS and Azure, which is Microsoft, or that's a hyperscaler. So it just shows you from 04 to now what the expected capital expenditure from these companies is on infrastructure. And man, I don't know if it's right or wrong, whatever it is, but it is meaningful. And to the extent they end up on the wrong side of it, I don't know if it's gonna matter, because I think there's just a bigger risk of underspending than overspending, my understanding. But Amazon's throwing 100 billion, you got Microsoft with 80 billion, Alphabet 75 billion, and Meta doing their billions. I heard recently that Microsoft was walking away from a ton of gigawatt capacity that they had initially signed up for. So who the heck knows what this is gonna look like? But the market is kind of priced to perfection. And I think so far this year, we've seen the problem with a market that's priced to perfection, where the S&P is struggling, and you get international markets that are priced less to perfection, right? Eventually price seems to matter, that are kind of supporting us. I think just kind of to complement this chart, and then I'll let you kind of share what you think, is this other chart for about the largest US stocks evolving over time. And this just gives you an opportunity to look at what the top 5 of the S&P was back in 75 and in 5-year increments since then. And yeah, Nvidia's up there right now, and Apple's up there since probably 2010, whatever it is, but this is going to change. And then the other interesting piece, as far from a pricing perspective, all of that basically multiple expansion that was experienced in the semiconductor space has come back to earth, and now it's right in line with the S&P 500 from a pricing perspective. So is it all done? Is it time to buy? I have no idea, but I think that first chart of all the spending, eventually that's either got to turn into revenue and margin and profit, or you get a little bit more pain.
It's going to use up so much electricity, though, right? I mean, I already
Yeah.
we had a client that was part of on Coral Gables, part of the leadership, and was saying how it was already really expensive to put in electric charging stations everywhere all around the city here, because it wasn't worth the money. It was so expensive, and so it'd be a benefit for all the car owners, but the city couldn't substantiate it. So now you're adding in all these data centers that take just a mountainous amount of energy, which we already used in the last few years with Bitcoin mining and all the other stuff that was taking a lot of energy. And it's not going to come from oil, and it's not going to come from other places. It needs electricity, from what I understand. I don't know if we're going to have enough, and I don't know if they can keep spending at this level and keep the exponential growth that they have. But I agree with you. They have to do it now. I think our partner Josh would tell you they're spending a little bit recklessly now, just to try to keep up, and just to try to say, we're not going to be the one falling behind. We're going to do as much as everybody else is doing, but they're not getting a lot of value out of it at the current moment.
Yeah, I think the risk that they see is in underspending, not overspending, right? So time will only tell. And again, a big part of this administration is basically trying to address what you just said, which is the cost of a gigawatt of energy, or whatever the unit you want to use is. I don't know enough to comment on that intelligently, but a lot of the reshoring of manufacturing is in the hopes of catching up to China, whose price per kilowatt hour is less than ours. So again, grab the popcorn and let's see what happens.
Okay. Well, let's shift to spending and income.
I'd love to.
So this is
Speaking of spending, went to Dick's Sporting Goods this weekend, buy a few things. $800 later. Good gosh.
well, they have the prices tag on everything, Marco. So
Gosh.
you knew ahead of time what you were buying if you added it
Oh
up in your head.
gosh, I know, but the kids, you're doing some stuff, little
Oh, you
baseball bat
can't say no
here,
to the kids, huh?
bathing suit. No, you know what's funny? I say so much no to the kids. They didn't get a single thing. They only got things they needed. I had them remove balls from the cart. Ash Schaefer, man.
Okay. Well, he still found a way to spend $800.
Yeah,
So,
exactly. It's so bad. Okay, so tell me.
well, I'm not sure which part of the chart you were here, but we're looking at here the percent of earners, the top 10% are in the bottom, going all the way to the top of the chart, the lowest 20% of earners. And you can see how much of spending is now accounted for by the top 10% of earners. And if I can read you the numbers here, the top 10% of earners, that's making $250,000 a year, now account for 49.7% of all spending, a record going back to 1989. 3 decades ago, they accounted for 36%. The top 10% now account for 1/3 of GDP, gross domestic product. And the bottom 80% spent 25% more than they did 4 years early, barely outpacing inflation of 21%. Now, the risk is that a stock market sell-off, a decline in home values, the confidence that you've been alluding to in previous charts, if that causes the top 10% to cut back, that could have obviously a huge effect on the economy. And we're already, I think, seeing a bifurcation between those companies that are doing really well. I was reading that sort of travel and cruising and hotels are at record highs. But then you look at other things that are not doing as well. Big Lots filed for bankruptcy. Kohl's and Family Dollar are closing stores. So the low end is having some trouble. The high end is doing quite well. And we need the high end to keep going. Otherwise, this economy is going to go into recession.
So it's interesting to look at the trend because that's 1990, it's slowly, steady, just kind of working upwards. Or isn't that top 10% the one that you would think is the least sensitive to a recession or markets falling?
Well, but I think everybody, though, reacts to recession, right? Like you think about our clients who are probably most of them in the top 10%, they even cut back. They don't feel as comfortable spending. They push things back. They're worried about their financial plan. I think if you got billions, yeah, who cares at that point? But if you're talking about someone who has millions, it still could do real damage. A 20% decline would be $1 million if you had $5 million invested.
I guess you'll be our billionaire index. We'll see how you react once a recession comes.
I would love to get there. I'm a few billion short, a few 100 million short.
You'll be fine, dude. Throw a zero on. Okay.
Between me and Warren Buffett, though, we've got $1 billion.
On average. But tell us, foreign investors apparently like US stocks.
Yeah, so I think what's gone unnoticed by a lot of people, because I talk to clients and they are quite surprised, is that the European stock markets are having a banner year. Start with that. The 7 most popular or biggest companies in the DAX 40 account for 40% of the index's gains. Sound familiar?
It does, but it's too soon.
So surprisingly enough, that as of Q4 2024, overseas investors own $16.5 trillion of U.S. equities. That's 18% of the U.S. equities, the highest share on record. That's up from 8% in 2000, and 2% in the 1950s. So foreign investors own a lot more of our U.S. equities. The Goldman Sachs has published a note saying they believe foreign investors will keep on buying because the U.S. market size and liquidity is far bigger than Europe and China. So it's impossible to invest large sums anywhere else. And furthermore, they expect the S&P 500 earnings to grow 7% per year for the next few years, outpacing Europe. And the weak dollar makes the U.S. stocks cheaper for overseas buyers. So, part of the reason, I guess, even though, I guess, with European stocks doing so well this year, they're still investing in foreign because I think everyone looks at the tech companies we have, the lack of regulation compared to other places, the stability of the government. All that's sort of comes into question at these moments. But basically, we're still a good place to put money.
Yeah, on a relative basis. Come on now. That's it. Even our critics prefer to stay. Thank you, Stephen Dubner. That
1/5
chart
is a big number, though.
I'm sorry?
1/5 is almost a big number.
No, I know.
Right? You always think of home country bias, right? You buy what you know. So Germans are buying German stocks, French are buying French stocks, but there's a lot of people buying U.S. stocks.
It doesn't say the number, it says the percentage of US companies that are owned by a foreign entity, I guess, is what it is. You know what throws me off on this chart is, did they just not like Bill Clinton? That trough in 92 to right around 2000 where it just drops off?
Well, that's the other thing is this backward looking? Are they now owning stocks because of how well U.S. stocks have done over the last 15 years?
Of course they have.
We'll have to see.
Been the only game in town, man.
To be continued.
Oh, I know. You mentioned it, last little nod before we sign off here. Consumer sentiment as measured by the University of Michigan sentiment study, down to 57 friends.
Bullish,
that,
baby.
What?
Bullish, baby.
Well, obviously, it's always a counter indicator. The average there, ladies and gentlemen, is 84. We're clocking in at 57. Only time it was lower than that in the past 10 years was in June of 2022. And we all know what was happening then. Stocks for the long run.
Yeah, I guess you gotta. Which stocks? US stocks, foreign stocks, semiconductor stocks? We don't know.
All right, signing off. Thank you, Brett.
Have a good April Fool's Day.
That's right. By the way, I wasn't recording. April Fool's, buddy.